Good afternoon, traders. This is Christian from Hertz Tribeca Trade Group, and it is Friday, September 4th. So, last public video before the long weekend, and wow, a lot of volatility, obviously, in the last 2 days. Some interesting stories out there about some of the recent market activity regarding the option buying and so forth. So, we're going to cover all of that. I'm also going to talk about something a little bit different too. I'm going to talk about the value versus growth. I talked about that briefly on Bloomberg TV today at around 3:15. It was nice to be on there again, so I appreciate that, Bloomberg. So where do we start? Well, I think the theme of the day that I put in place is, it's just funny how this market works, right? We don't see any type of volatility for basically what, a month and a half, right? So basically since June, all the way, we go through July, so basically 2 months. Right, so about 2 months, we haven't seen any market volatility. Market goes straight up, and then all of a sudden we get some nasty stuff like in 2 days. Right, not the even like, oh, we're going to go down 2%. Nope, we're gonna, we had some really, I think at one point, the Qs were down like about 4% again today, which, they were down, heavy yesterday. So it's just one of those things where really the market kind of got overcrowded and it ran very hot. And we know all this, right? We've been talking about this all week, how there was some warning signs in the market. The RSI got up to an 81, right? Overbought in both the S&P and NASDAQ. So I'm not going to rehash all of that, and obviously the VIX going up while the S&P going up. That's a surefire warning signal as well. So that transpired. So these are things to kind of review over the weekend or next week and just say, hey, how do I kind of protect my portfolio a little bit better when we see these warning signals, right? Often the market does give you these clues, right? Even if you're following price and trend like I am, which is my primary go-to indicator is price and trend. But I also look underneath the hood to kind of look for some of these warning signals. And, I think that there was enough given, right? And, it wasn't like this was a major surprise. However, it's tough to position for it. It really is. Buying some protection obviously works, as well as just the way that you're positioning for this. What was particularly difficult, I think, was I think really this week kind of started, or not this week how it started, but we started to see what's known as like a rotation into value. Why that becomes so not so much straightforward is because so I wanted to kind of expand upon this this mechanics within the S&P and why it's so difficult to have these value rotations, because everybody's been in a lot of growth names. And so if you look at the performance today, all right, we'll bring this up. We'll talk about the VIX too. There's a lot, like I said, there's a lot to talk about. But if you look at what outperformed today, right, and we can kind of move these sectors. This is what the intraday move is. I want to look at the. I want to go ahead and look at what performed really well today. The banks performed really well. So why didn't the banks, steel names, financials, oil names, right? Why didn't these names buffer the S&P to make it actually go higher? Well, we heard a lot of, a week or two, a lot of the arguments, very razor thin analysis from some commentators in financial media about, hey, it's only these big tech companies that are responsible for the market performance in the S&P. This is a bad thing. Number one, that's wrong. Because it's just how the index, and we talked about this about a week ago if you're a regular viewer of my videos, but we talked about this about a week ago where we said that's just how the index is set up. If you're angry that the index is market cap weighted, then you need to go complain to S&P, right? Because they're the ones who basically do this, as well as MSCI. So that's a function of how the market works. The bigger names, a market cap weighted index like the S&P or NASDAQ, is going to stack the biggest companies as the largest weights. And by mathematical formula, when they perform well, it's going to bring the whole market with it. When they perform poorly, it's going to bring the whole market down, right? And that's kind of what we saw today. Even though you had some really nice strength that was being masked a little bit because the S&P is market cap weighted. If you look at the weights, right? If we you've got 28% tech. Again, this is not something that is a market breadth issue in this particular situation. It's just the way that the index is set up. It's called, again, it's called market cap weighted. So that's why you have these big moves based on what tech is doing, because they've become the biggest companies. And they could, there's things that they could do if they really wanted to remove this skew in the S&P. They could, right? And then if you look at financials are only 9%. So if they have a great day, they're not going to be able to pull the whole market with it, right? We've heard that before, previous years. Oh, it's the bank. These banks need to outperform for this market. No, they don't, because they're only 10%, right? They don't need to perform well to make this market go up, because they're such an insignificant. I don't want to say insignificant. 10% isn't insignificant, but what happens is, once people start to see that these groups are going down and the market is getting pushed down, what that also leads to is some selling of the actual ETFs, right? There's all different types of players out there, right? A lot of what we heard this week is people trying to always put a reason behind these pullbacks, right? It's a combination of factors that usually do it. I heard about, people love to tell these stories about, oh, it's because of this option hedging and da 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 da. Yeah, that could be partially with it, but it doesn't explain everything. So, I understand that there's a lot of market detectives out there and who want to tell a story so that they can seem in the know. But really, at the end of the day, we don't really have to know everything that happens underneath the hood. We just basically need to profit from it, right? That's the real thing. End of day, right? So same thing with this SoftBank story about, oh, they're the ones who bought all the options and so forth, and this really shouldn't make much significance to you if you're a trader. Unless you are specifically investing in SoftBank, then this shouldn't matter to you, right? Just as we've known for weeks that the call activity has been outrageous in the last couple of weeks. What difference does it make what fund it is, or whether it's small investors, or everybody tries to wrap a nice story around this stuff. It really doesn't matter that SoftBank did this. But they did. I mean, what you want to take away from this, here's what you want to take away from this. When somebody does all this purchases all these calls and so forth, it will lead to the market being pushed up like this, because every day this happens. This wasn't just this particular situation. The market makers, right, who are making markets in options, when they sell an option to a customer, which is usually a fund, hedge fund or institution, yes, they have to hedge. That's what their job is every day. It's nothing different with these particular options. They were just bigger than normal. Yes, so what happens is they go and they buy stock to hedge, right? Because the market makers really, and I used to do this type of business, so I'm speaking to you from personal experience. Their job is to basically make the commission and maybe make a little bit of proprietary trading in that, with their hedging. But their job is not to take excess risk. That's not what a market maker does. All they're doing is offsetting that risk, right, by going out and purchasing shares. So when you see a big order in Google or in Amazon, yes, they have to go out and purchase the shares, right, to facilitate that order for the customer. It's just market mechanics. People are like, all of a sudden, like, I'm hearing, oh, well, that's the reason, because the market went up. The reason why partially why the market did this big run is because, yes, there was some big orders, but it's not anything different than what a market maker does every single day, right? Right, and then people get into all like this like gamma stuff and so forth about trying to tell a story. Yes, if it's a bigger move than expected, yes, there's a extra kicker, amount of buying that has to take place with that stuff. But again, there's a lot of mechanics that are going on. Remember, when you see all this call buying on the tape, it spurs more call buying because people all see it. The whole Twitter sphere sees it, right? And it causes all the smaller, investors too to get involved. So anyway, it's a little bit about just what we saw this week. And I think really, the takeaway from this is, I think there's a lot to kind of learn from these market dips because what happens is what's called you lose that muscle memory, right? And I think in this case it's volatility memory, right? You start making some bad decisions because you're not getting tested every once in a while and you're carrying too much. So the major things, I'll give you a couple reasons here why traders have a tough time, or investors have a tough time with these market dips. Number one, they're not positioned correctly, right? I say this a lot because I see it a lot, and I was there once too. Is that you're trading too big of size. Right? When the VIX is like a 20 or the lower 20s, it's a different story when the VIX gets back up to 32. The market is moving so much faster, right? So if you're taking the same size that you were taking a couple weeks ago and the market moves away from you, your P&L is really going to move, right? So you have to make sure that you're not getting over that your position size is not too large and also too short term. That's really one of the major issues for retail traders is for some reason they've been told by somebody, I don't know who, that trading weekly options or short-term options are an easy game. They're not. Those are your most volatile options, and they have very little recovery. We were going over an example earlier in the Q&A talking about how delta affects your options. So, for example, I bought. I'll give you an example a mistake that I made yesterday. Right, I personally was not expecting as big of a move to the downside as what we got. So, I was trading against a little bit of support, and I bought some Q's calls, thinking that we were kind of backing into a level that we could hold. The delta for those was about a 40, 45. They were like a little bit away from the money, and what happens is if you're wrong, and these were September calls, so it's a short-term option position. If you're wrong and the market continues to fall another 2 or 3% like it did yesterday, the delta, which is the sensitivity of the option price to the stock, goes from a zero point 0.4 to a 0.25, right? So that means that the option price, once it goes from a zero point 0.4 to a 0.25, the option price becomes a lot less sensitive to the price of the stock. So even if the Qs recover, right, now my sensitivity, I need a much bigger move because my delta is smaller, right? So you have to understand like these concepts, and especially inside option trading. One of the things that I did, and of course I will show you my trades today, but I will get away from option trading once the VIX goes up to these levels. It's just too hard. You're dealing with a VIX that's changing, from a 38 to a 30, right? And your option prices are going to go all over the place, right? So if the market starts to recover and the VIX goes down, well, you should know if you're trading options that the implied volatility is one of the components of option pricing. And as IV goes down, that means the option price goes down, so even though the market is recovering. So, these are important concepts. I go over them as much as I can in the trading room so that you don't make mistakes of, these common mistakes of trading too short-term options, knowing when to trade stock, right, over, knowing when to trade stock versus options, right? Here's what I was doing, a lot of trading stock today. Right? I was trading Amazon stock. I was trading Square. Right? Made a little bit of money. Traded a little bit of options in Roku. But that's basically, if I didn't mention Square, I got out of Square pretty early, and again was kind of looking for base hits and doubles. One of the things too I would also put in here is, mistakes often made is trading in the rearview mirror. Well, yesterday I didn't have such a good day. I got to make up for that, right? You have plenty of time, right? And there's going to be a lot of opportunities this month, right? As the market comes in, comes in and hopefully comes into support and bounces a little bit. We'll see. We'll see if that materializes. But there's going to be a lot of opportunities in names that people have wanted to get into. But you have to be able to survive, these market dips and not blow yourself up. And the traders that are trading these short-term options, they're going to have a harder time recovering because they're taking on too much short-term risk, right? The other thing to note here says Berkshire Hathaway looks like got out of Wells Fargo. No longer reports direct stake in Wells Fargo. That just hit the tape. Yeah, so that's one of the major issues, and so again, I think there will be some great market opportunities, but you got to wait until this market stops going down, right? I think that was the $1 million question, today from some traders. Hey, do we go ahead and buy now? You have to be patient. I'm getting so many questions about, I think from younger traders who want to know, like, if the market, is this name going to move today? You got to just relax a little bit and kind of wait for these things to kind of work their way through, and trade against a level. Realizing that no one has a crystal ball is one of these things that you have to get to, as you have to get to that point as a trader, that you're not predicting, that you're not trying to predict short-term movements. All right, so moving on. I talked about the market mechanics, right? About how these value rotations are become painful, because growth is such a big proportion of the indices. So I talked about that. We talked a little bit about the performances. Let's look at the VIX for a minute. Before we go to the VIX, let's just zoom in here. A few traders noting that we did break the 20-day moving average at the end of the day in the S&P. However, we're into the top of value, right? So you got a nice hammer bar. So this to me is not breaching any support. I view the market value, the value areas, greater than the moving averages, right? We also did this. If you think it's such a death sentence, look at what happened back in June. We broke the 20-day moving average more decisively on 6/11, and notice we kind of hung around here a little bit, rallied, gave it back, and then moved up. So this is a good scenario for you to look at, because also a tendency for some traders, like I just said, is like, hey, does this mean we're going to just go right back up? We don't know that. Sometimes it takes a while to shake out, and my gut instinct says that we're probably going to hang around here a little bit, after such a violent move to the upside and a big move to the downside like we saw in June. Look at what we did for the rest of the month of June, right? We basically hung around here. So that's what you kind of need to prepare for, is that this may not just come right back up in the next 2 days. If it does, that's great. What I'm confident in is, the way that I make money in the market is basically following the trend and capitalizing on, some movements that we see intraday. So I'm okay with this. As long as we don't see the VIX really start to pop back where it was. Let's go over the VIX now. Let's talk a little bit about this. Right? This is kind of the normal type of, I don't know if this is, I can't chalk this up to its, 2 days of volatility yet, right? Well, we're going to need to see this basically fall back below the 200-day moving average. I think that's a good reference point for the VIX, right? The last time this was June 11th, right? And you can model this stuff out a little bit from past experience and say, wow, volatility actually went up this third day, then came in and then trailed off, right? But it was a process, right? It's not going to be like a 5-minute type event, right? It needs to work its way through a little bit. Now, again, I think that we have a good chance to kind of, for volatility to kind of, who knows what we do on not Monday but Tuesday, but these little volatility moves, if this is all that it is, is generally not, not that big of a thing. It's kind of needed every once in a while for the market just to clean out all the euphoria that's in the market. All right, so that's the VIX, and then the other one is the VXN, which is the VIX for the Qs. We don't know based on this, right? This finished basically flat. You kind of have a doji. What does a doji mean? It's indecision, right? So you need more time. All right, so if you're buying a whole bunch of things at the close today or today, it could work for you, but it could not work for you too. We don't know how this is going to, for a doji in the Qs, because I know the reason why I spent a little bit more time on the VXN and the Qs is because I know a lot of retail traders like to be active in that space. All right, so that's the whole thing, is to kind of react to price action and be a little bit comfortable with knowing that you don't know. I mean, so this is also good. You got a hammer bar that's still above value, but it doesn't mean on Monday that we can't get inside value. We need to see a nice bounce, and we don't know how that's going to work out. So be comfortable with not knowing a little bit, right? And understanding the process, right? So we'll see how this develops on Tuesday, right? You can't really draw too many conclusions from this other than it's pretty positive that we recovered all the way from the lows, and basically put in that floating hammer bar on the 20-day moving average and above value. So it's pretty good. It's a better scenario than where we were, I think, in the morning. Right? Pretty decent, range for the day. Right? From where we started. By the way, failed move. It gave you a chance if you wanted to. It was something that we talked about pre-market, that hey, if you kind of got caught yesterday, you could get out, and you really had to do that in the first 5 or 10 minutes. So tricky as always, right? They don't make it easy. All right, so we talked about the VIX, we talked about VXN, and yeah, we'll kind of leave it there, I think. And we'll see, I'll give you a couple trades that I'm looking at. I thought this was pretty interesting for the day, this Alley Financial, right? So again, thinking about things a little bit differently, right? This name saw call activity today. It was up 6% for the day, right? So this is why I think that you kind of have to be patient with this stuff. Clearly, there's some rotation into some under-owned areas, right? It's not a whole market sell-off when you see something like this up 6%, right? It's just a lot of rotation. And as I mentioned, these value rotations can be very difficult, and they're masked because of the, if I'm not pronouncing that right, so you can't hear it sometimes on these videos, but masked, MACKED, right? It's because the growth names, the Apple, the Google, Amazon, Microsoft, the FANG names, right? Plus a couple other names, right? Because they're so big, you're not going to see what's going on underneath the rate, with this type of move. The IWM is the other thing that I wanted to mention, right? The IWM, we'll have to keep an eye on this one, right? Could it break down here, right? It actually held up much better than the other indices today, right? So again, a lot of things going on today. There will be some great, analysis that we're going to do this weekend, and I'm looking forward to that over the long weekend. And you're going to get some great opportunities here, I believe. But you got to be able to withstand some of the, while the VIX is above 30, right? You need to just basically get through that. Or if you're really good at scalping and playing some things to the short side, you could actually do pretty well here. But you have to go back to what I said here with watch, how many positions you're carrying and, your trading size. Those could really, cause you to stumble, right? And cause you to really have to dig yourself out of a big hole for the rest of the month. All right, guys, that's it. Thanks for watching. Enjoy. Have relax. Get away from the screens for a couple days. That's what 3-day weekends are for. I think it's actually good to let this market breathe, like a fine wine, a little bit, and we'll go from there. We'll set up nicely for next week. We'll have the macro video, and of course we'll have the weekend watch list. Have a great weekend, everybody.